And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody out there. Welcome to the Coach's Playbook. It's Tuesday, April 4th. Today, we're talking about something that happens from time to time. Maybe not an everyday occurrence, certainly not. We're talking about trading gap opens. And of course, there was something that led to this. There was a pretty big gap open. Dan, I can already see the dejected look on your face here. We'll get to that real quick. But first, Hogue, you a trader shout out for us.
Yes, we have a trader, Brock H., currently up $7,000. He's been scaling in short the S&Ps pretty much since the open. Nice trade, Brock.
Love to see that scaling in. So one of the reasons we preach managing your size and trading small, in the Topstep program, you're not holding positions overnight, but those gaps that occur, the opening gaps, are still super important. And what brought this to our attention this week is OPEC cut production over the weekend, and there was a big gap up in the oil market. So Dan, maybe you could tell us a little bit about this right now, and we'll kind of go to more gaps in general after.
Yeah, absolutely. So as everyone knows, the oil market itself is very susceptible to inventories, whether it's increasing inventories or cutting inventories. Well, OPEC came out, I think, John, correct me if I'm wrong, was 1.6 million barrels a day cut. That was a pretty decent number, kind of a surprise. We knew there were talks about it. And it was really at a pivotal location for the oil market itself. If we looked at the oil, we had found over the last few months, we had found really nice support right around that $74 to $75 range. Well, that's right where that market closed last Friday. We had the cut and we had a nice $5 gap higher on the open. And the reason, to me, this is an important topic to talk about. There's a lot of risk that's involved. We talk about, people want to carry positions and how do you handle that? And if you're at Topstep, we want you to be flat. We want to focus on that risk management, but there's also, trading that you do outside of here. And if you are carrying positions overnight, this could have happened, between the full close and the open back up at 5 o'clock, you can get these gaps. That's why you really want to be flat when there are times you can't get in and out of a position. Sunday night, we had a nice long weekend. We came in and we had a $5 gap higher. There's a lot of risk on the table for people if you're carrying that position. I know a lot of people got smacked pretty good Sunday night on the open. Looking at where that market was on the close on Friday, I think a lot of people looked at that and said, hey, I like the short side here. There's an opportunity. Remember, what was once support sometimes becomes resistance. Again, support and resistance is a hindsight. And this is a prime example of that, right? You can't call it support and resistance until you look back at it. So we saw that gap open. If you were short that position, you were down on the open on Sunday, about $5,000 a contract. Not something you want to come into on a Sunday night, especially if you've had a nice weekend, getting outside, having fun. If you come into a short Sunday night, you're not happy. I promise you that.
Not a great way to start the week. And gaps are built differently in that, especially the holding. So I would really never, plus I was trading treasuries, but still was not a big fan, i.e. our risk managers would not let us, even if we wanted to, of holding any sort of real outright trade over, say, the weekend. So the weekend gaps are worse because obviously, depending on your market, it's just closed for 2 days as opposed to an hour or whatever if you're trading indices.
Exactly. And there's things you can do too. If you're carrying those positions over the weekend, you can hedge that position. You can work to, get risk neutral. We call it delta neutral, right? Like your delta, which is your exposure or your risk. On the option side, you can get neutral, meaning that no matter really where that market goes, yeah, you're taking some heat, but yeah, you're covering yourself in a sense. And that's really one of those things you want to think about is where's my risk when I can't get in and out? If you're trading outrights like here at Topstep, that's why we want you flat. When you can't get in and out, if you carry longer positions, think about how do I offset my risk going into this close? I know a lot of guys will put a position on going into a close, and then they'll peel that position back off because now they have more control once that market opens back up.
Right. And it might be a little different if you're swing trading or something like that, but I just don't like the idea in general of most of our people probably aren't trading spreads or hedging with options like you described in that. And plus that's eating into your juice too. I would kind of lean more towards don't hold outright positions over the weekend. If you get flat, it's going to be higher or lower in the long run about half the time when it opens and you can get back in. That's just my thoughts on that. So we kind of talked about what the gap is there, but now we can talk. I want to send us over to Hogue about trading gaps, because gaps in any product, we talked about oil right there. It's been a while since we've seen big gapping markets. Back during the beginning of COVID, there was gap a day for weeks on end.
Yeah.
Hogue, maybe you could help us understand the significance of gaps and how they can play into your trading strategy.
Well, sure. I mean, there's really two different kind of gaps. Weekend gaps tend to be somewhat rare, right? We don't see markets that are going to move 550 ticks, 500 ticks away from where they closed on Friday, usually, unless you have a position in it. The day session gap is the one that we see a lot more often, and the day session gap, by definition, is you look at the range from the previous day. If we were to open outside of the range from the previous day, that creates a gap. We had a gap in crude oil day over day. We gapped higher this morning in crude oil. We also gapped higher in the S&Ps. So that gives you at least a degree of reference. The weekend gap in crude oil, there's a degree of reference in that as well. The perception of value of a barrel of crude oil changed abruptly over the weekend. Well, it's the same thing in the day session gap. So we open above the previous day's range, there's a perception of a change in the value. It's either going to accept and continue, or it's going to fail to accept above that previous day's range and then trade back into the previous day's range. So just to define what a gap is, the weekend gap in crude was a big gap. Those don't happen all that often. But a day session gap is anytime the market opens above or below the previous session range. The market is in essence telling you it's opening out of balance. It's opening out of range. Some of the better opportunities may come earlier in the session, but usually there's a kind of a basic rule that I use for trading gaps day to day. Like this morning, we opened with a gap in the S&Ps. If we weren't able to close that gap relatively early, I would have been looking for opportunities to continue to buy that market. We couldn't close the gap. That's telling us that over time, the market is accepting higher pricing. That didn't happen. The market opened, it closed the gap quickly, took a look above the early high, failed, back into the range, back into the value, back through value, and now continuing to the downside. So the gap rejection gave us the opportunity to look for a short in the S&Ps today, and even in crude oil. We opened higher in crude oil with a gap from yesterday. The gap didn't hold. We got into yesterday's range, through yesterday's value, and continued even further beyond that. So I like gaps. I think gaps give you great context, and I think they give you good trading opportunities, and at times trading opportunities where you're going to severely limit your risk on those trades. So Gaps, first thing I'm looking at is, do we have a gap in this market today or do we not? If I'm in range and in value, I'm going to stay patient. Better trade locations are likely to come as the day goes on. If we open with a gap, I'm going to be a little bit more on edge, or not on edge, but a little bit quicker to look for a cheap opportunity to get into a trade early in that session.
Thanks, Hogue. I'm going to put this next one over to JD, but JD, if it's not in your wheelhouse, let me know. One obvious change, because most of our people are trading equity indices, of sort of the day gaps that you discuss, is that trading happens so much more around the clock now than it did a long time ago, where there would just be more, a gap was kind of a gap to a certain extent. JD, do you still find it useful, or has the usefulness of gaps in the markets that are trading all the time sort of reduced over time? Or how do you feel about trading gaps now?
Well, first, I think there's a couple things from a day trading perspective. I think there's a couple things you need to ask yourself when you're trading around gaps. First, how much did the market gap, especially around the open or pre-open? How wide was the gap? Percentages count here, I think. Statistically speaking, if there's a gap of more than, say, 5%, the odds of that gap filling in a timely fashion, I think, drop significantly. Next, you have to account for what, if any, news or fundamentals likely cause that gap. Like Dan was mentioning in the crude oil, I'll just use that as a recent example. When you factor in those things like production cuts and something like Japan breaking with U.S. allies by agreeing to buy Russian oil above, that $60 price cap, it makes for a pretty bullish scenario. You need to take all of these things into account when you're day trading. There's also something that looks very similar to what you would call a breakaway gap in crude oil, which is signaling possibly a change in trend. If this turns out to be a breakaway gap from a technical fundamental standpoint, there's only a couple scenario. Well, let me retrace my steps there. As a technician, you have two options when the market gap's open. You can anticipate a follow through in price action, get in the market as soon as the bell rings, or sit out that first half hour and wait for price action to paint a clearer picture. In a situation like we see in crude oil right now, if this does turn out to be a breakaway gap from a day trader, I'm not looking to get short in this market at all. I think the most logical answer right now would be something like waiting until we hit that huge target area of $100 a barrel before this market comes back and fills this gap. Let's also not forget the markets love to make fools out of day trader, smaller retail traders like us, so anything that we're thinking is typically usually factored into the market by the time it crosses our tape. These are all things you need to take into consideration when trading on big gap days like we're seeing, like we just saw.
So it seems a lot of the time that from a day-to-day day trading standpoint, the gap where there's not necessarily a ton of news is a little bit easier to play with than, as you mentioned, if something gaps by 5%, that's because something happened. And unless that thing that happened is resolved or there's new information that comes in, it's not going to fill the gap. Like this is a perfect example. We talk about with the oil, the 5%. What's the cause? The OPEC stuff, the other stuff JD mentioned happened over a weekend. It opens back. Yeah, I think it's silly to try and think that that's it's got to fill the gap here. No, nothing's changed yet. But what Hogue mentioned, when you see gaps that are maybe a little bit less extreme, shall we say, there's definitely room to play with whether it's going to come back and close that or whether it holds it and then continuation from there on out. So does anyone else have any gap analysis? We're talking gaps. It's gap time. Anything else on gaps? Because I wanted to do just a little bit of a Q1 refresh too, or review.
I just wanted to kind of highlight, both you guys touched on it there, but it really is, JD brings up one of the most important things here. There is what you see technically in the charts, but there's a lot of fundamentals at play. And though you have to factor both things, there are traders that trade technicals, there are traders that trade fundamentals. You need to have a decent understanding of both Even if you say, I focus on trading technicals and that's all I'm going to trade, right? If we were thinking just from a technical standpoint, looking at what happened in oil, that may say, hey, I'm going to look to see if this thing can close that gap back down to where we were. But when you think about the fundamentals that come into play here, those factors that are heavily involved that impact the price of that commodity, that changes. I think you have to, I don't want to say that changes how you look at the market, but you have to factor that into your decision making.
Good point, Dan.
And one last thing. If a gap is in the direction of your longer time frame trades, if the market's been trending to the upside and you get an upside gap, there's information in that. When we were looking at the S&Ps this morning on the market prep, the S&Ps gave us a signal yesterday. Volume was low and we lost open interest. The gap this morning, therefore, to me, was more likely to be filled because of that information. So it's not just, is it a gap or isn't it? What is the bigger context? What is the market trying to tell me?
Yeah. Bigger context, always good. So I wanted to speaking of bigger context, just before, we got 10 minutes here to jump around a little bit. We're in Q2 now. Q1's over. Most of our people are trading equity indices. Really interesting first quarter. A lot going on. Definitely got what you paid for in the markets. NASDAQ's up about 20%. Here's something interesting. I did not think about the indices being up as much as they are, just because right at the end of the last year, we hit some relative lows, right? I think there was some, I might have done this myself, a lot of tax loss harvesting going on. Got to bring down that number, which, by the way, it's April 4th. Where are your taxes? Take a look. NASDAQ's up about 20%. S&P's up about 7 or 8%. There's been all sorts of movement on the front end of the curve. We had bank failures. Really, a lot of the NASDAQ, it's back to the old story. The best performing ETF in the universe this quarter I saw was like one of those triple leveraged FANG plus things going on. FANG coming back. Facebook's more than doubled since its low. Google's been strong. They've all been strong. That's kind of dragged the NASDAQ ahead. The even weight NASDAQ is not up, is like maybe break even or close to it. It's not anything special. I'll go around the horn here. Does anyone have any kind of cleansing or final thoughts on Q1 and what we would define the trend is that we're in right now in any of those markets? And Dan, I'll throw it over to you.
Jack, I think there's a lot going on right now that factors into these markets. I think you're spot on, right? We look at it, we're up approximately 20% in the NASDAQ here this year, but that last piece of the year, that last month or so, we saw a big dip. We saw a lot of, like you said, potential tax harvesting. So that I'm trying to factor out. I'm trying to look at where we were before that sell off. I think we're still establishing, trying to define or understand, do we like this direction that we're going? Can this continue in this direction? I think there is some uncertainty still out there. You can see a little bit of fear in these markets when they do have down days. They come in pretty decent. And so for me, it's really not marrying any sort of bias right now after this first quarter. We had a strong quarter, no doubt about it. Seeing 20% up is a great number. But for me, it's really don't marry, recognize the fear in the market when it shows up. And if you're in those shorts, don't be afraid to take them off. And if you're in the longs, same thing. So really, you just got to continue to be patient here. I think that's the best part about being a day trader. You can get out of that position rather quickly and adjust.
Yeah, we're definitely in a rangy market, but it's, looking at right now in the ES, got sort of a 5-month trend going of what we like to see, a little bit of higher lows across there, kind of creaking up. Is anyone bold enough to make a call besides a ranged market right now? JD?
This is a tough question. We're getting signals on both sides here. The NASDAQ had its strongest start in, what'd they say, 20 years. Gold's hovering around all-time highs again. The Fed's looking at another rate hike before a possible rate cut towards the end of the year. There's a lot of mixed signals, I think, in this market right now. This is not the time to fall in love with any kind of position. But what really caught my eye was money piling back into crypto in Q1. Anybody notice that? Bitcoin was up over 70%, Ethereum up.
Yeah, I got Bitcoin at 28,000 right now. Ethereum back to 1865. I've lost. That is interesting. I kind of knew that, but at the same time, I haven't been following crypto too closely because that is not something that I am involved with.
I am to a minimal extent, but I'm still keeping an eye on it. Those numbers were just huge, though. Over 70% in Q1. That definitely caught my attention.
Yeah. Hogue, what about you? Slow and steady? He's on mute. He doesn't want to talk to me. You're on
Sorry.
mute. There you go.
I did mute for a second there. I always forget to unmute. Sorry about that. But
Me too.
Since our October lows, there is an upward hint towards in the S&Ps. The NASDAQ, I think, in the last month has performed much better. I mean, there's no real banks in there, so we didn't have to worry about the banking issues, which put in our lows here in the beginning or the middle of March. Since that, these equities markets to me have always amazed me with their resiliency. If we look at the from November to December, just November low to the December high, we're kind of range bound, but again, with higher lows and higher highs. As long as things don't go crazy, I think, that we can continue this move to the upside. And I'm always the optimist that way because, well, I just want it to go that way. But,
I say this because of the marrying position thing you mentioned. I get the strong hint from the traders that I talk to, retail traders, combine, people trading futures, that there is still a strong preference. If people are in love with one side right now, it's the short trade. And for 5 months, we've kind of been like, it hasn't been just some raging bull market where you haven't had opportunities to get paid short. But I think people are the sizable majority are more to taking that short side of the trade. And I just wanted to bring this up to those folks.
Well, it's something that the S&Ps have done since they started in 1982. The S&Ps eats shorts. If there's no bad news, the market is just going to continue to grind higher. So the less bad news we can have, the better off we're going to be.
That is being a perma short. You get a few good headlines along the way, but
I know guys that were perma shorts that made a lot of money. Donnie Slider said his longest position ever was short 10, but he knew how to find the turns.
Yeah, just something to throw out there. So it'll be exciting to see what happens in Q2. Hopefully another 20% up and everything. I could use it.
I think we all could.
Yeah, I'm down. Or
all right,
as you can say.
Dan, you got a quote for us? Take it home.
I do. Talking about gaps, there's a lot to it. They don't come in very often, but when they do, sometimes you take a little bit of a licking on it, and that's totally okay. And so I like this quote from Sir Richard Branson. Don't be embarrassed by your failures. Learn from them and start again.
Yeah. Virgin Orbit just filed for bankruptcy. So he's still doing it.
Still doing it.
Still doing it. Get in that jet ski, Branson. It'll be okay. All right. We'll see y'all next week. Thanks for tuning in. Stop by our morning prep, one-on-one coaching. Check out the group coaching. It's all good stuff. It's on the website. We'll see you around there. Have a great day. Bye.
Trade well, everyone.